The silver saga rolls on. In early 2026, Asia's thirst for silver has only intensified, while Western exchanges yawn at prices that now look quaint. Imagine waking up to headlines that say, Shanghai silver hits record 84 Oz, and Indian futures top bars 265 lakh kg. Meanwhile, COMEX futures plod along stubbornly around 80 days. It's like watching two different movies. On one screen, Chinese factories and Indian families are gobbling up physical silver at any price. On the other, US traders raise margins and shrug off the squeeze. If silver were a soap opera, this would be the plot twist. The plot's gone global, the villains and heroes are at odds, and nobody's quite sure whose side gravity is on anymore. Asia's silver squeeze continues. Asia's love affair with silver has kicked into overdrive. After December's fireworks, silver demand in India and China didn't die down. In fact, Indian silver futures, MCX March 2026, recently hit a fresh all-time high, about R2.65 lakh per kilo, nearly 85 Oz. That's more than twice the price at the start of 2025, driven by a falling rupee and cultural demand spikes. Festivals like Akshaya Tritiya and Diwali saw locals snapping up coins and bars. Reuters reports that at Diwali 2025, Indians were buying silver coins and bars with gusto. Dealers said, investors believe silver could outperform gold. The lure of silver is simple. During festivals and weddings, giving silver is a cherished tradition, and when word spreads that prices are climbing, ordinary families rush to buy now before it's too late. China, too, is gobbling silver. The Shanghai Gold Exchange, SGE, where real metal is traded and delivered, saw silver premiums skyrocket. On Deck 24, 2025, the SGE fix closed at about $78.50 Oz, a full $8 per ounce premium over COMEX futures. This gap means Chinese buyers are willing to pay far more for immediate delivery than Western futures suggest. As Silver Trade noted, such a wide Asian premium is a flashing buy now sign. It signals a real shortage of available metal, not just paper contracts. In other words, physical demand in China is so fierce that even after silver's global run-up, the spot price there raced ahead of the official futures price. Asia's grinding hunger makes for odd global optics. In Singapore and Dubai, silver prices have begun to track the Shanghai market more closely than COMEX, reflecting the actual metal crunch in Asia. Local Asian traders joke, we watch the SGE price, Wall Street's number is yesterday's news. This is a historic shift. For decades, COMEX in London led the choreography. Now the tune is being set in the East. One Shanghai trader quipped to Bloomberg that silver Owaing's most important exchanges are now the ones where delivery is real. In practice, that means prices in Asia have jumped well above $80. For example, international spot silver spiked to 84.61 on Jan 12, 2026, while COMEX futures briefly plummeted when U.S. margin hikes kicked in. More on that below. Key drivers, industry and policy. What's fueling Asia's frenzy? Part of it is simple cost. A weaker rupee made imports dearer, so Indians rushed to buy before their rupee fell further. But more fundamentally, silver is suddenly critical to the tech and green economy. Over 50-60% of silver now goes into industry, not jewelry. Solar panels, electric vehicles, 5G AI chips, water purifiers, even medical devices all need silver for its conductivity and durability. Solar PV and electronics, worldwide silver use in photovoltaics and electronics has quadrupled in a decade. China alone dominates solar manufacturing, gobbling silver for panel coating. EVs and batteries. Electric vehicles consume 79% more silver per vehicle than gas cars. As EV production surges, driven by China and now India's green push, silver demand is set to jump. AI data centers, silver is crucial in advanced chips and servers, e.g. high-frequency circuit boards use silver-palladium capacitors. The AI boom means more data centers and chips built, and all use silver. Add it up, and we face a structural deficit. The Silver Institute project's 2025 will mark the fifth consecutive annual deficit, some 95 million ounces short of supply, with cumulative deficits nearing 820 Moz in 5 years. Mine production peaked in 2016 and has since fallen. Ore grades are declining globally. Crucially, roughly 71% of mined silver is a byproduct of other metals, gold, copper, zinc, so higher silver prices done magically create tons of new silver mines. In short, demand is rising fast, especially in China and India, but supply is stuck. This fundamental gap has savvy analysts predicting triple-digit silver prices ahead. One bank recently floated an $85 to $110 target, and even a possible $150 scenario, if shortages persist. Finally, consider the macro context, inflation, and geopolitics. After peaking interest rates, central banks, led by the Fed, have signaled rate cuts in 2026. That weakens the dollar and boosts safe haven metals. In 2025, gold skyrocketed to $4,600 Oz on turmoil, and silver initially rode its coattails, but then surged on its own, becoming the poor man's gold. Even Wall Street's own analysts note that Silver's rise was powered by a unique blend, a shaken confidence in paper currencies, plus a mad dash for tech metals. As one commentator put it, silver became a hedge, not just against inflation, but against everything, from trade wars to sanctions. It's no coincidence the US just labeled silver a critical mineral in 2025, acknowledging that it's as strategic as lithium or cobalt now. West Coast versus East Coast, two tales of silver. By contrast, Western markets seem puzzled. After silver's staggering rallies, major US exchanges, CME Group's COMEX, have tried to cool the action. In late December, CME hiked margin requirements on silver futures for the second time in a week. In simple terms, they demanded traders lock up 3 times more collateral to hold silver bets. The result? A wild price collapse. Within days, silver's spot price leapt to about 84 OZ, Asian market highs, then crashed to $70 Oz, one of the largest intraday reversals in history. This margin squeeze was a deliberate choke on speculation. CME officials said the silver gyrations required higher margins to prevent disorderly losses. Some market watchers argue the margin hikes themselves triggered the crash by forcing leveraged longs to liquidate. As one trader admitted, CME's moves took some fluff out of the rally. In any case, paper silver tumbled, confirming the US will not easily allow unchecked silver leverage. Meanwhile, Western regulators and commentary outlets still mostly treat silver like any other commodity. Washington focus remains on tech competition and dollar strength, not bullion hoards. There's been talk of critical minerals programs, e.g. Besant's supply chain forum, but silver barely got a mention among flashy topics like semiconductors or batteries. If China quietly builds giant silver stockpiles, US officials haven't signaled alarm. In London and New York, pundits still scratch their heads. Silver at 100, preposterous, they laugh. To which we must politely remind them, nothing in modern markets defies supply and demand forever. They might say silver's rally is a bubble, but bubbles pop when the currency loses credibility. And today, S-World is flush with extraordinary monetary policy and trade tangles. Physical versus paper, a deepening divide. The drama boils down to one persistent theme: paper silver versus physical silver. Think of it this way. On COMEX and in bullion ETF ledgers, silver is cheap, around 80. On the ground in Shanghai and Mumbai, actual bars are worth $84 or $90. This gap isn't T-idle trivia. It is a flashing signal. When paper markets, futures, ETFs, large bank vaults, don't reflect the true scarcity of metal, an arbitrage is inevitable. Physical holders in Asia pay hefty premiums. COMEX longs dream of forcing delivery. In John 2026, for instance, clients reported paying up to $25 Oz over spot for ready silver in India. For perspective, consider London's vaults. According to LBMA reports, silver inventories in London actually rose sharply through 2025, a 12.8% increase year over year. That sounds like plenty, but it likely reflects institutional players parking allocated silver, not hitting the market. And vault numbers don't measure who's outside those vault doors scrambling for supply. In reality, as Western inventories have gradually tightened, COMEX registered silver hit multi-year lows in late 2025, Asian stockpiles have tightened faster. In short, the world is seeing a bifurcated market. One price in the charts, paper, another price in the vaults, physical. If and when these get forced to reconcile, look out. CME's margin hikes and futures rollovers, backwardations in some contracts, show exchanges know something's off. But they're basically playing whack-a-mole. Tighten here, release pressure there. Hedge funds remain jittery. Everyone's watching arbitrage desks, asking what happens if a big holder has to deliver physical silver they don't own. Past episodes, 1979, 2011, ended with shockwaves. The majors in Chicago might laugh now, but there's an elephant in the room. If an unwinding squeeze hits, it could dwarf those decades-old events. Global maneuvers, mining, trade, and diplomacy. Behind the scenes, countries are quietly moving pieces on the board. China's not only hoarding metal, it's also tinkering with exports. As Money Control reports, starting John 1st, China imposed strict approval on silver shipments. Only a few exporters may ship silver abroad now, tightening global supply. Beijing denies a ban, but even a slowdown in shipments is squeezed for the rest of us. India took notice. By January 2026, New Delhi accelerated talks with Peru and Chile, two of the world's largest silver producers, for free trade agreements. The goal? Eliminate tariffs and get a reliable flow of silver doré and refined metal. India already leaned on China for over 40% of its silver imports. If Chinese shipments dry up or hike in price, India needs Plan B. Peru produces 3,000 plus tons yearly, and Chile likewise. Such deals, combined with a recent historic surge in India US silver imports to $4.8 billion in FY5, show India is betting hard on keeping silver coming. Latin America isn't the only target. There are whispers that New Delhi is also eyeing Kazakhstan and Mexico, and even stockpiling via state-owned reserves. On the flip side, the US ore strategy is more subtle. There have been no big US purchases of silver announced. Officials seem content to let market forces play out, focusing on securing other critical minerals, like lithium, in official programs. Some trade hawks argue the US should also try stockpiles or export controls, but so far that hasn't happened. Meanwhile, Russia's legacy of huge silver output is effectively offline. Supply from its mines collapsed under sanctions. South Africa's Krugerrand fever for gold might soon include silver, and global miners are scrambling. But note, silver mines are mostly byproducts of other mines, so few can turn on a dime to raise silver output. All of these moves, export curbs, FTAs, swap lines, or even whispers of bans, act like dikes and reservoirs in a storm. Every action shifts flows. In today's data-driven markets, even talk of a new trade deal with Peru or a Chinese refinery glitch can send prices one way or another. What does it mean for you? A darkly humorous take. Okay, buckle up. Here's the lay of the land distilled for different audiences. For the curious, average buyer. Silver isn't just for Breaking Bad or Mayan calendar cultists. It's also in your solar panel, smartphone, and maybe in that fancy car battery of the future. If you were thinking of buying silver jewelry or coins, guess what? It's more expensive now. But maybe think of it this way. If the apocalypse fails to show up, you've lost nothing. If the conspiracy nuts are right about currency crises, you might be sitting on a sleeping bull. If words like paper silver, backwardation, and SGE premiums sound like a different language, just picture this. The price in Manhattan is $80, but in Mumbai we're paying $90. Which one do you trust? The Wall Street ticker, or your hands clasping a silver coin? For retail investors, look, we know you live on Reddit and get bombarded by $100 silver now banners. Real talk? This is a roller coaster with no seatbelts. Diversify. Don't put everything in silver. It might not stay a one-way ride up. Stay informed. Watch global headlines, Fed meetings, China policies, trade talks. These will move metals. Be skeptical of internet hype, especially from strangers promising silver to the moon. Some folks want you to panic or FOMO so they can profit. Consider cost. Buying physical has costs. Retailer premiums, shipping, insurance. If you grab coins, budget 5 to 10% extra over paper price. Have an exit plan. Know why you own silver. Is it insurance, speculation, or a hobby? Decide in advance when you'd sell or take profits. For financial pros and advisors, you speak the lingo, so here's the quick thesis. Markets are on edge. COMEX margin hikes, roughly 2 to 3 works higher in late 2025, are a flashing amber light. Exchanges are trying to tamp down leverage. If you manage futures or advise funds, check your positioning. How short or long are you in silver? Who's doing that arbitrage between $84 in Shanghai and $80 in NY? Are your models allowing for Asia premium risk? Also note, geopolitical risk now includes commodity flows. Your clients might think of silver as a domestic cheap asset if stored in London, New York vaults. But a war in supply, say China export ban or Peru unrest, could break that assumption. Think of SLV or silver miners. Their price is set on COMEX, but their actual inventory or mines might be sitting overseas. If physical premiums explode, the NAV of a silver ETF could temporarily decouple, because ETFs typically hedge or operate in futures. Remember how gold ETFs sometimes trade at a discount during stress? Silver could do worse given its volatility. Keep an eye on regulators too. Rumors are swirling that the US CFTC may probe silver trading. After all, the old LIBOR rate rigging scandal in metals, 2014, was about gold and silver. If any big banks are caught manipulating silver prices, we could see fines and forced position liquidations, which would roil the market. Imagine JP Morgan closing a massive short. That's a sudden short squeeze waiting to happen. In summary, advise clients that silver's story has 2 possible endings. It could continue as the canary in the coal mine and run even higher. Some forecasts now openly talk 100-plus targets on healthy supply-demand fundamentals. Or it could revert under pressure. If global tensions ease or if central banks normalize rates, the gold-silver flight might stall, and silver could give back gains. As always, stress test portfolios for both. Meanwhile, for a dash of humor, picture this. 2 traders at the big banks. One in JP Morgan's Chicago office, one in HSBC's London office. They each have a screen. On the left, the Shanghai silver price is screaming $91. On the right, their COMEX screen stubbornly shows $80. JPM trader cracks a smile. Well, we can't both win. If I raise our price, Asian algorithms might eat us alive. If I lower it, well, I'm pretty sure Bats just got an email from some central planner. His London colleague sips tea, saying, maybe we should call the Fed, see if they can whisper Q. You can imagine them shrugging and muttering, grab popcorn, the next Fed minutes might just declare us obsolete. Or imagine silver itself as a street racing horse. It burst out of the gate at $84, wild-eyed. The jockey, CME margin, tried to yank it back, legs skidding. But from the next lane, the China and India horses came charging, elbows flying. It's a photo finish none of the crowd predicted. Now everyone's asking who actually crossed the line first. Where we stand, dawn or dusk? In the end, there's no crystal ball. Part 1 of this story, 2025's Wild Ride, taught us silver plays by its own rules. It reminds us that precious metals can explode in crazy ways. The last 2 parabolic runs, 1980, 2011, reshaped markets for years after. Are we entering a silver dawn, where markets finally price in the real scarcity, paper prices catch up, and holders of real metal win big? Or is this a silver twilight, where central planners and regulators orchestrate a soft landing, sending prices slowly downward as the old system creaks on? We won't predict which. But we'll say this. If you've read this far, you're in the top percentile of aware observers. You know silver's a unique animal. 1 part commodity, 1 part technology metal, and 1 part monetary artifact. You're aware the next few months could see either bank balance sheets creak under forced selling, or vault doors open as new buyers step in. Whatever happens, expect drama. Silver has started squeaking loudly. It may well be the canary in this financial mine. If Wall Street's slick professionals are suddenly looking pale and nervous, maybe they should be worried. At the very least, keep watching, because in 2026, the silver screen is about to get a lot more exciting. Is silver a silver bullet to save our economy, or a shot that could take down the house? The curtain's just rising. Stay tuned.